Most business owners are accidentally tipping the IRS, not because they want to, but because nobody ever told them they can reimburse themselves tax-free using a tool the IRS literally wrote the rules for. So let's break this down in an easy way that is simple, practical, and yes, maybe a little fun. An accountable plan is the IRS approved method that lets your business reimburse you for business expenses paid out of your personal account without paying taxes on those reimbursements if you follow 3 specific rules. However, a lot of business owners wonder, why can't I just pay these expenses from my business account? And technically, yes, you can. But here's the problem. Many of these costs that go through the accountable plan, like your phone, internet, home office, or vehicle, are mixed use. And when the business pays for them directly, you're mixing personal and business expenses in the company books, which is exactly the kind of thing the IRS loves to inquire about. An accountable plan fixes that. Instead of the business paying the whole bill, the plan lets you document the business portion and only get reimbursed for that part tax-free. The business claims a clean, legitimate deduction, and your books show a clear separation between personal and business use. That looks much better in an IRS audit. It keeps your records clean and saves you thousands every year, making sure you're taking the right deductions the right way. All right, so here are the 3 specific rules you must follow. These come directly from Treasury Regulation 1.62-2. And when you understand them, you can reimburse mileage, home office, cell phone, internet, travel, meals, all tax-free. Test number 1 is business connection. The expense needs to have genuine business purpose. Driving to a client meeting? Yes. Driving to meet your ex because you want closure? Definitely no. Buying software for your business? Yes. Buying a new gaming laptop because you feel creative? We both know the answer. That is a no. This rule comes straight from Regulation 1.62-2D. Test number 2, substantiation. You must prove the expense happened. That means receipts, mileage logs, any documentation that shows the amount, the date, and the location, and most importantly, the business purpose. The IRS talks about this in Regulation 1.62-2E and Publication 463. If it's not documented, the IRS pretends it never happened. And test number 3 is the return of excess. If the business gives you an advance, let's just say $1,000 for a work trip, and you only spend $700, you have to return the leftover $300. It is not a bonus. It's not close enough. It's required under Regulation 1.62-2F. Now, the IRS also gives us a friendly safe harbor timeline for the expense reimbursement process in Regulation 1.62-2G. You have 60 days to turn your receipts. You have 120 days to return any excess. And there's even an optional quarterly statement if you use periodic advances. 60, 120, quarterly. Easy, easy, easy. So here's how you implement an accountable plan correctly. Step number 1, you adopt a written plan. This isn't optional. IRC 62C literally requires that the rules be defined in your policy, and they need to say, we reimburse business expenses according to IRS regulations. Okay. Step number 2, choose your expense categories. These usually are mixed expenses, and it includes mileage, home office, cell phone, internet, travel, lodging, basically anything that qualifies as an ordinary and necessary business expense under IRC 162 paid out of your personal account. And before you ask, no, your gym membership does not count unless your doctor writes a prescription stating that CrossFit is medically necessary. And even then, that belongs in a health plan, not an accountable plan. Step number 3, you create simple documentation tools. That means a mileage log, an expense reimbursement form, a home office worksheet, and a system for submitting receipts. Step number 4, You actually submit the documentation. Receipts need to show the date, the amount, and the business purpose. Mileage logs need your starting point, destination, miles driven, and why you are going where you are going. If the IRS audits you, clean documentation is your best friend. Step number 5, the business reimburses you off payroll. Not as wages, not as draws, not as distributions. Reimbursements should be categorized as non-taxable expense reimbursements. If you break any of these rules, Regulation 1.62-2C says that reimbursements instantly become taxable wages. Step number 6, fix mistakes fast. Late documentation becomes wages. Excess that isn't returned becomes wages. And if the IRS sees a pattern of abuse, the entire plan becomes non-accountable under Regulation 1.62-2K, meaning every reimbursement becomes taxable. We do not want that. And here is the thing. Most business owners never take advantage of this, even though it's one of the easiest tax strategies available. Here at Save Accounting, we help business owners take these rules and put them into action cleanly, correctly, and in a way that actually saves you money. If you'd like support setting your accountable plan or building a tax strategy that protects what you earn, use the link below to reach out. And if you're the DIY type, there is a free sample accountable plan waiting for you down below. Stop tipping the IRS by accident. Start reimbursing yourself the right way. This is one of the simplest strategies the IRS already approves. You just have to follow the rules. I'm Alex Rivera, CPA. Thank you for watching, and I'll see you in the next one.